To consistently outperform the equity market, this is what expected of us. Investing at its core is all about the way we approach it. For instance, just check your portfolio from the previous year till now. Just look at all the changes you have made in just 12 months. There's nothing right or wrong with it, but that's how you approach your investment, right? So you have your own approach and I have mine. We all do, but what works is what matters the most. And even if after considering all the points that I'm about to mention in this video, if you are still confused about direct equity investing, then I most certainly suggest you to check ET Money Genius. It's a membership program wherein professionals manage your portfolio for a minimum fee. More on ET Money Genius at the end of this video. Hello everyone, I'm Rakshith Pai, and in this video I'll explain the golden principles we as an investors must follow to outperform the stock market. Number 1. Valuation. Valuation is important because we must know what we are paying. We must know what we are buying into. And trust me, no one can value a company with full certainty. We all make mistakes and that's fine as long as you learn along the way. It is up to us how we value a company. But never invest in a company without doing your own research. When I say research, it doesn't mean you crunch hundreds of formulas or mathematical figures and such. Just read the balance sheet of a company to understand its current position. See the debt, the cash position, its asset, liabilities, where it is invested in, whom it has given cash to, who is their creditors, etc. Basically, read a balance sheet as if you are the company's owner and you just receive the information about your ownership. So you'll be curious to know what all has happened in your company up until now. Subscribe to this channel and check our website where we'll be posting many well-researched articles on various valuation methods and techniques. Check the link in the description for more information. Number 2. Diversified asset allocation. Will you invest all your savings in that one company if a legendary investor tells you to invest in it? Maybe he's right in suggesting the investment, but what if the company goes down? Now let's imagine that the investment went down 30%, and since your portfolio is in this one company, your portfolio return is also now at minus 30%. I mean, just investing in one company makes your investment that much more vulnerable to market corrections. Now let's check with a slight diversification where you got just few investment with a huge allocation. For example, let's say 5 companies with 20% allocation in each. And if there is a 10% drop in one company, your total portfolio has dropped just 2%, given the fact that the other investments stay constant. According to research, you can reduce over 90% of market fluctuation based risk by owning 15 to 20 stock portfolio. Just imagine a 20 stock portfolio with an equal distribution. The maximum you can invest in one company is 5%, so the negative impact one company can have on your portfolio is up to 5% and no more. Most mutual funds are instructed not to allocate more to any one company. This is probably why they don't get burned as often as retail investors do. Number 3. Size of investment. We just saw the importance of diversified allocation. But not being over diversified is equally important. I'll give an example. We are all familiar with Sri Rakesh Jhunjhunwala. Yep, the big bull of Indian stock market. His net worth was estimated to be in excess of 35,000 crores. But almost 40% of his net worth is in one company, and that's Titan. Coincidentally, Titan was his biggest life-changing investment. Let's take Mr. Buffett's portfolio. Mr. Buffett is the world's largest investor and over 40% of his portfolio is in one stock, that's Apple. So what we learn from such legendary investors is that they keep the winning stock intact and in fact add more as it grows. Coming back to Sri Rakesh Jhunjhunwala, did you know that he invested in Titan stock back in 2003 at just 40 per share for Rs 10 lakh? He then added more as he was sure of his investment. Today those holdings are worth over $2 billion. Number 4. Understand the market. Now this is very important. Understand the market you are planning to invest in. Instead of going behind the financials of a company at the initial, just take a step back and see how big the market is. For example, ITC Limited. It's the largest cigarette manufacturer in India with over 75% market share. And the cigarette sales are a cash cow for the company that's growing in double digit each year. The only close competitor is VST Industries. There is no way for ITC Limited to lose its market share in cigarette manufacturing than by reducing it by themselves. What's also noteworthy is that the ITC is spending much of its capex on enriching its FMCG business, something away from cigarette. This is just one company. There are over 7,500 companies in India, each with its own market, business strategy and environment. Understand their business, the market they operate in and the way they generate money. Number 5. Market cap. The undeniable fact is that small efficient companies can create much more wealth than mid-sized and large cap companies, because once upon a time all the mid and large cap companies were small cap, right? So try to buy and hold on to small cap companies. In my next video I'll share tips on how to select small cap companies. You can check this article for more information. For now, my suggestion to you is that you allocate at least 10 to 20% of your portfolio to small cap companies with market capitalization of less than 10,000 crores. This way, allocate just 1% to each company. You can create a separate small cap portfolio of 10 to 20 companies. And even if one of these investments perform as expected, trust me when I say this, that this one company will return more money than your entire investments and much more than that too. That's the power of equity investing with the conviction for long term. So these are my top 5 rules to consistently outperform equity market. Now let's find out more about ET Money Genius. Hi there. Do you take stock tips, invested in them, lost money? Well, instead of repeating the same mistake, earn better returns by subscribing to ET Money Genius. ET Money Genius will understand your risk profile and suggest different investment options for varying time periods, thus helping you build a very well diversified portfolio. High quality stocks that yield better returns are chosen so that you need not wait for years. So what is the expected return? Well, if you had invested as per the ET Money Genius high growth stock strategy for any 7 years in the last 15 years, you would have earned 22.4% CAGR. The wait ends here because with no additional work, you can earn a wonderful return just by subscribing to ET Money Genius membership. Check the link in the description. Thank you for watching.